So I'm Geoff Goodell from University College London. I'm going to talk today about the future of money. And first I'm just testing to make sure this works. Laser pointer, good. So this is, the presentation has been reformatted to accommodate PowerPoint format, so there might be some errors. If so, we'll work through it. So I'm from University College London. I'm a lecturer in financial computing. And my focus, or the focus of my research, is on socio-technical systems in financial services. Now you might ask, well, what does this have to do with the future of money? Well, about a decade ago, I made an interesting observation, which was that a salad bar that was close to where I worked stopped taking cash. And I thought this was really strange. And indeed, in the years that followed, more and more businesses started conducting most of their business online. And more businesses started refusing cash at the point of sale. And I thought, what's going on with this? And this actually, as it turns out, is a very significant change in the structure of the relationship between households and businesses and government and institutions. And this is really why this has become a salient topic. Ultimately, the rise of the digital economy, which is to say e-commerce, or transactions done over the internet, and the decline in the use of cash for ordinary retail payments, is really about changing the parties that are involved in transactions. And one of the observations that I made was, well, when people say digitalization, really it's often just a euphemism for intermediation. And it's not really about the technology, but rather about the relationships among the actors that are involved in these transactions. So I would encourage you to think about it in this frame while we proceed through this today. And I'd like to remind you, I'm not a Luddite, for the avoidance of doubt. This is not about technology. This is about the socio-technical systems surrounding money. So we're going to talk about this in a few different sections. First, we're going to talk about modern retail payments and some of the tussles that are going on among institutions. And I'm going to argue that what we're seeing is actually not simply an economic issue or a financial policy issue or a monetary policy issue, but actually a political issue. And we'll talk about why that is and what the implications are and what this means in terms of who needs to be at the table in this debate. And then we'll talk a bit about requirements, these fundamental questions. What do we really need money to be in order to be functional in our economy? And finally, we'll talk about the future of money in a number of different areas that I think you'll find interesting. And hopefully there will be some time for questions. And I hope that you make them hard, and frankly, I'm okay with interruptions as well if that's appropriate. So hopefully we can get started. So there are some errors like this. So apologies for that. Now the issue here with modern retail transactions is that we have a choice between cash and retail banking. Now cash involves a direct and private interaction between transacting parties. Currency is held by their owners. Fungible tokens provide assurance that transactions will succeed. So that means that when I walk into a coffee shop and I carry cash with me, and we all know what cash is, sometimes it's cash and keys, we all know that the transaction is going to succeed because the cash is not linked to my identity. It is value that stands alone. And it's worth the same as everyone else's because we know that it's fungible, which is to say it is interchangeable and undistinguishable in practice. And unfortunately, what we also see with the digital economy is that in modern retail banking, it's not the same, right? So interaction is actually between regulated institutions. And the currency itself, the money, is actually held by institutions, and what users have is just a claim on the balance sheet of custodians, of banks, in the case of of many of these transactions or transactions that take place with cards. And as a result, transactions could be intermediated or blocked. The custodian could charge me a fee in order to get my money out or send it. And users might be subject to discrimination and profiling because, as you know, if you're using a credit card, you get no privacy. As anyone who has ever looked at, if you've ever looked at your bank statement, you will know that your bank knows not only your habits about spending money, but also your location, also some aspects of your financial circumstances and what changes, when you go on holiday, when you're home, when you're not. It knows about perhaps who you happen to split the bill with. I mean, these are the kinds of things that banks get to know. You might ask, well, why is it that anyone would use anything other than cash to transact? Well, that's a good question. And we raise this question, is cash really a disappearing payment option? And we did this research project called FIRE a few years ago, and FIRE stood for Future Infrastructure for Retail Remittances. We partnered with the University of Edinburgh, NTT Data. NTT, of course, is based in Japan. It's the world's largest telecoms company, and British Standards, through which we do a lot of work in ISO and CEN-CENELEC standards. And we observed that, well, you know, there are some issues with the changing nature of consumer transactions. But if you ask this question, why do people use cards or mobile payments to transact? And often you will hear the answer, well, it's convenient. And I'd like to push back on that just for a moment. There are other reasons other than convenience for this. Part of it is that some people only accept card payments. And this expectation that I might go to a venue that doesn't take cash might incline me to not want to use that as my primary form of payment. There are also other benefits or other motivations as well, such as the fact that people have built this very strong infrastructure for facilitating transactions that's very expensive to build, but they've built it on the back of data harvesting and transaction fee collection, which are big business for them, and indeed a larger share of the revenues to asset custodians such as banks that hold this money. So it's funny to say this because it seems that banks are bringing in a new source of revenue, payment service provision, that is not about banking, which, by the way, traditionally is about taking deposits and making risky investments. Payments are not that. Payments are about telecoms. And we need to understand more about what's going on here to appreciate why banks have ventured into telecoms. And in order to really understand this, we need to look back further. We need to look back at least as far as 1996, where we see that the Financial Action Task Force, which is a Paris-based organization that seeks to address questions related to financial crime around the world, Financial Action Task Force in 1996 said that we should encourage the replacement of cash. Well, that's a really interesting thing. Why would they say that? And we see an argument here from 2001 where basically this author said maybe cash is really about illegal activity, and maybe what we need to do is limit cash and replace it with transactions that can be monitored and profiled so that we can implement dragnet surveillance, and wouldn't that be better for everyone? Well, this is interesting. This is 20 years ago. And around this time, Narayana Kocherlakota, who was chair of the Federal Reserve Bank of Minneapolis at the time, had said, well, money is really memory. It would be much better and more efficient if we just had record of everything that everyone owed to everyone else, and if it were a public record, and then transactions would be simple. Well, maybe not so simple if we care about privacy, and maybe not so simple if we care about control. And indeed, this question about whether our main objective is to restrict the ability to have control and exercise control over their own assets is actually the motivation for certain ways in which the digital economy has evolved might be a real question for us. So moving forward to the current day, or at least 2 years ago, the FATF released a report saying that decentralized finance, so that's something that many of us in this conference care about, non-fungible tokens and unhosted wallets are dangerous because they might potentially implicitly allow people to violate this travel rule, which we think is really important. Okay, so let's understand some background on this FATF travel rule. So basically what this says is that in all electronic transactions, you need the identity of the payer and the recipient in every electronic transfer. That is the letter of the FATF travel rule when it applies to general transfers of money. And ostensibly there are some exceptions for e-money and these kinds of things, but in general, they want to know who is paying whom, and in so doing, they have the ability to establish profiles. And indeed, FATF has a history of being questioned for its use as a geopolitical cudgel by powerful countries against other countries. And this should give us some indication of what this is all about. Now, when we fast forward to the various central bank digital currency proposals around the world, we look at examples like the digital euro, and the ECB had recently developed a proposal for the digital euro. They made it part of a single currency package that they packaged up with a promise to protect access to and acceptance of cash in the economy. But if we look at the digital euro proposal to the letter, we might have reason to pause when we think about what they're really saying about cash. And the reason that I say this is that inside this proposal, they have a massive focus on fully offline payments. And the definition of fully offline payments that they use in the architecting of this proposal is payments in which neither the sender nor the recipient are connected to anyone else except each other. So it's a very strong standard for offline payments. And cash, right now, is a really excellent way of conducting transactions that are fully offline in this way. And cash in this context is not under threat. But the reality is, the main problem, or the main challenge, actually, is that there is the rise of the digital economy, where one of the parties, or both, are online. And they had argued inside this proposal that online payments have the same privacy as card payments or other bank-to-bank payment mechanisms today, which, by the way, is zero privacy. Whereas offline payments might hope to have this privacy, but unfortunately, there's an expectation that it works by relying upon certified hardware doing remote attestations, which of course means that you don't really control the devices that you use to conduct your transaction, and you have to trust that you're actually private, even though you can't actually trust your device, which is very strange. And if that weren't bad enough, we have this idea that it's all really basically just an account. And when they say digital euro payment accounts, they really mean it. Basically, someone would have an account that happens to hold digital euros rather than euros. Well, I guess my first reaction was, well, I have news for you. I mean, any kind of account with a bank is already digital euros, if it's euros, except that unlike with a bank account, these digital euros can't be rehypothecated. So this is very strange too. So what's the point of having a custodian in this powerful position to happen to hold these digital euros when the whole point of having digital currency is being able to possess and control your assets directly? So this is very strange. And of course, the wallets are implicitly linked to the payer's identity. And here in Europe, many of you might be familiar with EIDAS 2 and this idea that we will have digital identity wallets that will be registered and linked to our identity, that when we conduct ordinary transactions, we're revealing our ID. Well, if we expect this to be the same wallet as the digital euro wallet, well, we're in trouble. But even if we don't, it's still just an account. So what's going on here? It's very strange to be focusing upon fully offline payments when cash is an excellent fully offline payment solution already. So why would you do this unless you wanted to attack cash? So this raises questions about the candor of the argument that we're really going to protect access to cash. And more generally, it's not just the ECB that's saying this. There are other central banks around the world and other groups that are working with central banks to develop proposals around the world about the structure of these digital currency proposals that would be operated by platforms orchestrated by the state. And by the way, these are being subject to massive political objections, largely because of privacy. And yes, in Europe, there was the ECB actually did a consultation a few years ago that identified privacy as the #1 issue that individuals were concerned about in the deployment of CBDC, but yet their proposal has zero privacy for online transactions. So why are they tone deaf about this reaction? I mean, this is actually quite something. And I think if we look closely at this, we see that this is a political challenge. And if we look a little closer still, you might be forgiven for saying, well, actually, maybe the ECB is ignoring this problem because they're actually identifying a different problem instead. For example, the problem that something between 60 and 70% of retail transactions taking place in Europe now use card payment networks, retail transactions I mean, card payment networks, which is to say rails operated largely by companies such as Visa and MasterCard, which, by the way, are not based in the EU, they might be concerned about the costs and risks to the strategic autonomy of European regulation in this space. Well, that might be a legitimate thing to be concerned about, no question. But if you're missing this reality that it is not the share of card networks among intermediated payments, but rather the share of intermediated payments among all retail payments that is the problem, then you're missing the plot. Now, yes, there are various different motivations for CBDC beyond this. Yes, we have private money, foreign money, mechanisms that people might be concerned about closed-loop payment systems like they are in China, WeChat Pay, Alipay, for example, where you don't have banks behind the transactions, or maybe foreign money, right? You might have a bank that is actually hedging out all of its risk to the local currency because people are conducting their transactions electronically via these card payment networks. And yes, let's not forget the data harvesting subsidies. And I'm not just talking about parties that take transaction fees, but also parties that get access to the ability to profile individuals and sell information to insurers and creditors and employers and other parties who might have an interest, advertisers, other parties who might have an interest in profiling people. This is a really big problem. And yes, we have heard the argument that this is good for the developing world because this allows everyone to build a credit history. Well, it's not obvious that credit histories are good. It is not obvious that we can take a population out of poverty simply by lending them money and asking them to pay back at interest. So let's think really carefully about this. So, what do we really need money to be? Now, I'm sure a lot of you have thought about the tokens versus balances question, but let's review this quickly. Auer and Böhm, Raphael Auer and Rainer Böhm, published this paper I want to say it was about 5 or 6 years ago now, about CBDC. And they said, well, let's understand the difference between accounts and tokens. And they argue that, well, they argue that accounts are always linked to someone's identity. you have to identify yourself in some way. Now, maybe it's with KYC and biometrics. Maybe it's just with a key. Maybe it's with some kind of identifier that you make up. But whatever it is, if you're using an account multiple times, those activities and actions that you undertake with that account gives you a set of attributes. And what is an identity? But as ISO 22739 defines it, a set of attributes that distinguish an entity in a context. You transact twice with an account, that's an identity. Now, in contrast, a digital token does not have this requirement. The token has the value in itself, intrinsically. I don't have to negotiate it. It is not a legal claim that I have on some token issuer per se. I mean, yes, there is a claim that the token might represent, but the token itself has its value that will be accepted for what it is, not because of who I am. So that means that if we really want a wallet to be private, it needs to be non-custodial, and it needs to be tokens, not balances. So this is really important. And if we imagine that these wallets that hold these tokens have to be registered or identified, well, that means that we're basically linking them to an identity, and it's just an account by any other name. And so often when we use the term wallet, we just mean account by any other name. Now, there are various companies that have built non-custodial hardware wallets that have certain features that I think we can examine and think as being interesting, right? And yes, some of them might have secure elements in them for the use of their owners, but the protocols that they depend upon foundationally don't require that, which is really important. And the question that we ask is, well, what do we need those non-custodial wallets to do? Is it really just a USB stick that does some cryptographic operations? Well, these are research questions that we explored in our project a few years ago. Now, one of the observations that we made at that time was that when we thought about this security problem, actually card payments are not very secure. And yes, we know that EMV technology and tokenization are mechanisms to address certain problems that have been observed in card payments in general. But let me say this. Every time that you tap a card on a kiosk, the kiosk might present a number to you, but why do you trust that kiosk? Why do you trust that EMV device that the server at a restaurant is shoving in your face at the end of the meal? I mean, it gives you a number, but it could be any number. I mean, do you trust the hardware? It's not yours. You haven't vetted it. It's whatever the restaurant had. Do you have a choice? I mean, if the restaurant refuses cash, probably not. And ultimately, the expectation is that you are monitoring your bank statement very carefully, like a hawk, and if there's ever anything strange on it, you're supposed to complain to your bank and say, hey, someone overcharged me for this transaction, which is to say, the transaction says, well, I've left a stack of money on my nightstand in my flat, and I've left the door open. Why don't you go in and take what you need? And if you take more, I will send my bank after you. That's a very strange thing to be expecting, right? But that's de facto what's going on. And of course, your bank might decide, hey, you've made 4 claims like that this month. Maybe I'm not going to go after this one for you. I mean, it is really putting you at the mercy of your bank at some level to have them as your custodian that you must invoke in every transaction. You might say, well, hey, mobile phones. Maybe we don't use cards. Maybe we should use mobile phones. Well, yes, there are lots of questions about who actually controls the mobile phones. And one of the biggest questions with this kind of technology today is who is responsible for what a mobile phone actually does. And if you can't actually control what your mobile phone does, because all that it does is do whatever Apple or Google want it to do, then how could you possibly be expected to really be responsible for what it does? So yes, you've got that problem. But you've also got this large attack surface, just from the fact that this is a very complex device, not to mention the fact that there is proprietary hardware, which means that you can't build your own solutions that you can tweak or analyze. And if you're using the internet to transact, or much worse, cellular towers, you're going to leak metadata when you transact. And that's going to also be a source of profiling risk. So card payments and mobile phones don't seem to be the right solution. So we thought a lot about that as well. But ultimately, this question is, at some level, about the question of banking versus payments. Remember, banking is taking deposits and making investments. It is the wealth creation process that underpins so much of how we have money in wealthy societies today. But payment services are an increasing source of revenue for these banks. So have we introduced systemic risk from the expectation that banks now are principally about payment services for many consumers and not really about banking? And a lot of consumers don't even imagine that their bank is going to pay them interest or care on what that is, which is very strange, because in the not-too-distant past, that was a primary motivation for getting a bank account. But now, if you ask kids today, why do you have a bank account? They will say, because I want to pay for things online. And that's really strange, because that's not a banking question. That's something else. Now, digital currency issuers could collect revenues from facilitating transactions without necessarily being custodians, and maybe digital currency could be part of the solution for how to enable people to hold their own assets outside of custodial accounts, in their own possession, under their own control, but somehow regulators have missed this in their treatment of cryptocurrencies, right? Seems to me that a lot of regulators are giving people a really hard time when they're conducting transactions that can be considered private, or when they're conducting transactions that are not orchestrated by a custodian. So, what are we doing? What is the point of digital currency if all that this is just another fancy kind of account that happens to be operated by different sets of players? And yes, challenger banks in the UK, even though nowadays many of them do real banking, started, many of them, by just providing payment services. So these functions can be separated. And that's part of our motivation for working with telecoms companies in our research, because we understand that the relationship between banking and payments might be more accidental than people think. Now, some people might say, well, distributed ledgers. Do you really need a distributed ledger? Distributed versus centralized. What do you want? Why? You can have a highly private system, and this is important, and it might be news for some of you. You can have a very highly private system that is highly centralized as well. And in fact, in 1982, David Chaum wrote a paper describing what was one of the early cryptocurrencies, and this was 27 years before Satoshi Nakamoto. He said, blind signatures for untraceable payments. You can have an issuer basically issue you a token by having you create the token. You wrap it in a function that commutes in the public key algorithm, encryption algorithm, and get a signature. It's like putting a slip of paper inside of an envelope lined with carbon paper, hand the sealed envelope over to an issuer, have the issuer sign the outside, send it back to you. You open the envelope, discard the carbon paper, and now you have a signature on something that the issuer had never seen. Then you can go pay. How do you pay? Well, you tell the issuer who you're paying without telling the issuer who you are. And then you can pay someone else. That is interesting, but that doesn't require a distributed ledger. So why do we really need distributed ledgers? Really, it's about holding the party that's operating the system accountable for not having two different versions of history. It's forcing them to commit to a single version of history on an immutable ledger where the immutability is an emergent property of the independence of the validators in that set. And yes, that provides a lot of benefits. It eliminates the security risk of having a single party who could be captured, compromised, or fail. It avoids operational costs of securing that system, perhaps, and it also promotes competition among the various different validators in the network. It can be used to facilitate transactions in a way that can be accountable to the public. So these are actually good. But it's not the same as privacy. It's a different architectural choice. Now, there are various misconceptions about digital payments. There are some myths that are really important to consider. Number one, a consumer's balance must always be managed in an account. Now, Auer and Berm actually say, hey, accounts are great, and there are lots of digital currency designs that we've seen that are based on accounts or state transitions. I'm sure you know what these are. Now, it's just simply not true that it has to be managed in an account. You can actually hold tokens directly. And if you hold tokens directly, you might even, if it's designed appropriately, might even have privacy. Now, this idea that the payer must always be identifiable, well, actually, when we think about cash transactions, which work just fine, the payer is often not identifiable. And that's just fine. So why is it that when we design regulations for electronic transactions, we expect that the payer has to be identifiable? Now, I'm just saying we can separate the privacy requirements for the payer from the privacy requirements for the recipient from the privacy requirements for the system operators. These are three different questions, and they can be separated. Number three, this idea that in order to protect our system from abuse or capture, we need to know where all the tokens are. Well, that's manifestly false. Who knows where these tokens are? It's not in an account, but yet we know that it's coming back into the system because that's the only way to extract its value. We know that it doesn't last forever because this particular form of euros will not be in print 100 years from now, I'm betting. There might be a different one. If I have this one and maybe the ECB would let me say, oh, here's a relic, I'll give you a small fraction of that. It's possible. But this idea that we need to know where all the tokens are is a really strange requirement, given that systems that work don't necessarily have this feature. Surprising or not. And finally, this idea that consumers must always have the option, and apologies for this again, consumers must always have the option to ask their banks to unwind a transaction that they didn't want. Well, that's really strange, because this is an expectation that really what people need is credit, really what people need is value-added services that let you say, hey, this plumber that I hired into my flat to fix my drain didn't actually show up, and yet he took my money, that's not okay. Well, if we transacted in a different manner, this wouldn't be a problem. And yes, we can design digital transaction mechanisms to transact, and then if we so choose, we can raise issues with our recipient and identify ourselves if we choose. It doesn't need to be intrinsic. And this idea that every transaction needs to be subject to this paternalism is a little strange. So basically, we can do better by actually identifying what the real requirements are for this system design. We can actually say, hey, look, maybe we can have, maybe we really do need self-custody and privacy, but we also need tax and anti-fraud enforcement. Maybe we also need interoperability with bank accounts. Maybe we need to free the issuer from the responsibility of operating infrastructure the way they do in CBDC proposals. So we built out this analysis, and we thought that this was a different view than some of what we had seen. And we wanted to see, well, what can we design if we do this? Well, basically, our first thought was the goal is not to replace cash, because if you want to have a transaction that's offline, there is nothing better than cash, and cash works just fine. So all of this argument about this need to have digital certified hardware devices that transact outside of that context, that's very strange. It's also not to replace bank accounts. Remember, banks are about banking. Banks are about money creation. I want banks to exist. I want to have a bank account. I want to have a place from which I can invest in securities. I want to have a place that can receive payments into me from employers and clients. So bank accounts are great. I want to earn interest. But that's not the same. Like, we don't have to get rid of bank accounts. What we really need is a way to pay, a payment channel. That's what we need digital currency to be. It's really about payments. And yes, this can be of interest to central banks because they can preserve the monetary sovereignty of central banks, and it also allows us to directly hold central bank obligations. Right now, the only way to hold central bank obligations is via cash for ordinary businesses and consumers. Now, yes, if we design it right, digital currency can deliver privacy and control, but we have to make some very careful choices about this. Now, yes, in what we're proposing, you would have central issuers of tokens. You could have more than one. You could have different central banks issuing tokens. You could have private banks issuing tokens. But the point is that the clearing and settlement would be done by private independent actors. And payers would be anonymous, even though recipients are not. And that's very much like the design that's been proposed by the BIS Swiss Center in Project Tourbillon. So this is not a new design. Also David Chaum from 1982. So it's over 40 years old, this privacy model, and yet we're not seeing it very often today. And I'm not quite sure why. Now, this clearing and settlement question, yes, we can do this with a distributed ledger or a distributed system. But what's important to understand is trusting the central bank to implement monetary policy is different from trusting the central bank with your transaction data. The former is the central bank's job. The latter is something that really has to do with our privacy, and we really need to think twice before giving someone else the data about how we pay. And the opportunity for digital currency, CBDC or otherwise, is precisely about having this non-custodial and digital opportunity, which is different both from cash, which is physical and non-custodial, and cards, which is custodial and digital. But this is the opportunity. All too often, people assume that if it's not physical, then it must be custodial. That is false. So I told you a bit about this. This is our design. You can read about our paper for our proposal. You can read about it online. Basically, you have a Xiaomi and Mint to get your blind signatures following a signature request, and you send your data into some system, and then that redeems by paying the merchant. That's just a Xiaomi and Mint. We actually extend that by actually sending a commitment of the transaction to a relay operator and use a proof of provenance that we attach to the asset, and the asset maintains its own state. So we don't actually need to maintain this state in the ledger at all. And in fact, the ledger can be done completely. The ledger can actually record commitments in a way that's not only completely oblivious, but also completely disconnected from any data availability in this system. So all the data here is at the edge. The ledger just has commitments. And if this reminds you of Arbitrum, that's not a coincidence. These kinds of designs that separate transaction validity from data availability are becoming more interesting. And there's a reason that even in the Ethereum world, people are stumbling upon solutions that look more like this. And yes, we don't really need tokens to be managed on the ledger. The tokens can exist off the ledger. We don't need any state machines managed by validators at all, or any distributed computation, no smart contracts, to do this. DLTs are about externalizing commitments. It's about making sure that people don't equivocate about the history that they report. And yes, in this system, the ledger grows at a fixed rate with commitments on a periodic basis that, like Arbitrum, only record a root every certain period of time. And that, we think, is really efficient. The primary property that we care about is zero marginal cost for a transaction at the core of the ledger. And if this reminds you of the internet, well, it should. Because the salient property of the internet is that in the core of the internet, the tier 1 internet providers, the tier 1 internet carriers, have zero marginal costs for transmitting data. It's all fixed costs. If I want to send a packet from here to Japan, There might be a cost near me and near my recipient at the edges, the last miles, if you will, but there is no marginal cost in the center, and there is no bottleneck in the center. It's zero. And that's what we're looking to do here. And we think that systems that have this design are more likely to succeed because they will not require gas fees. And that's important. So yes, we can use this to implement CBDC. We can also use it to implement private currency. This is a general purpose kind of infrastructure combining the Chalmian Mint with the unforgeable stateful oblivious assets with the distributed ledger to prevent system operators from equivocating. That's it. These three things are all well known, but if we combine them, we can do something really interesting. Now, we've written about this, and I want to draw your attention to this article that we've written most recently, Retail Central Bank Digital Currency, Motivations, Opportunities, and Mistakes. So it's about what the future of money isn't. And maybe if we learn a little bit about what motivated some of the most recent central bank digital currency proposals, we might get some insight into what the future of money might be. Thank you very much, and I'm happy to take questions if we have any time at all. Yeah?
Are any questions?
Yeah.
Ask them outside because we don't have any time.
Can we have just one?
No, sorry, you
Oh.
have 15 minutes.
Okay.
Also, please come to the closing.
Okay.
On the main stage. Thank you.
Thank you.